Good Tuesday morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, D, you ready to roll?
Yep, good morning. Well, good morning, everyone. Let me share my screen here. And I think what we'll do today is look at Tesla, expected to report earnings tomorrow after market close. And one of the things we could do to get insights and perhaps maybe look for trading opportunities that might fit your particular um, position, or mitigate some of the risk on your portfolio, or you could find opportunities. And we could do that by looking at some of the most uh, traded activity in the options markets. So what we want to see is, well, what was trading yesterday? What was going on? What are people looking at? Um, and we could look at it from two perspectives today. We could see what were people doing in the uh, complex orders strategies, what type of strategies were popular yesterday, and what strikes, what options were people trading when they were using those multi-leg complex orders. And we could also look at the most active options or some of the biggest option trades to try to get an idea of what other people were doing, what prices were people trading these options, and then we could even evaluate the trade prices to get an idea where they are from a historical perspective. So let's try to see what we could fit in today. And I'm going to first start out by going to Tesla. So if you just type Tesla into the search, you will come to this summary page. And since we're looking at the options trades, I'm going to go on the left-hand side. And under the menu, we'll click options. And let's first take a look at the multi-leg trades. So let's click on that. And then we will come to this page that let's close this menu for now to expand our page. And we're going to come to this multi-leg trade analyzer. And what this does for us is look at the options trades and detects by the Oprah feed which trades are part of multi-leg trades. It then does the analysis connecting the most likely related trades and comes up with an analysis what was the most likely strategy. Okay, so when you enter in an order, you could enter in an order that involves multi-leg trades, like a call spread or put spread. So if you enter it in as a multi-leg trade, they have to get executed simultaneously. That's what this is looking at. What were the most popular strategies? And we could see here at the top, this is sorted by the number of contracts traded by strategy. So it could trade more than one time, two times, three times a day. Like this one traded 128 times, 5,986 contracts. And you could see between 11:24:10 and 3 o'clock and 24 seconds, we detected trades in this particular strategy. And it shows the top 5 by default, but you could go, and scroll through here. You could control and sort these columns, or you could even use these filters to do it by strategy type. But let's stay on the top one. And we could see that the top one we detected was a put spread. and it was the January 31st expiration, the 360 400 put spread. This put spread has 4 days to expiration, so it's very short term. In other words, it's really, looking at a put spread that's going to cover the upcoming earnings, and then it's going to expire by the end of the week. The strike prices, the difference is $40. So you could see it's a $40 put spread. Okay, and this traded for $13.78 on average. VWAP price $13.78 because it did trade multiple times. The VWAP bid and offer at the time was $13.66, $13.87. So this lets us know that the put spread itself traded at prices that were in between the bid and offer. Okay, so there was price improvement. There were traders or market makers, specialists that were willing to trade these put spreads that were priced better than the displayed bid and offer. Okay, so there's room there to negotiate for better prices. We could see they're $13.78, and the VWAP reference price of the stock was $429. So you can see that the higher strike is right near that the money. The lower strike $40 below. So this is looking at a put spread that if the stock happens to drop, it drops significantly. If it goes below 360, this put spread could be worth $40. It's trading at $13.78. Of course, if it goes up, both of these and stays up there at expiration, both these puts will be worthless. It'll be $0. So whatever, that $13.78 goes to zero. And it could be anything in between, right? So that here is the largest put spread. We could see below that, there's another put spread that traded. This one goes out further, March 21st. So this is 53 days to expiration. So now we're looking out further out in time. This is more out of the money. So this is looking at the 300, 350 put spread. So it's $50 put spread. That's the strike difference between the lower and higher strikes. Traded for $10.15. Also, if we look at the market, it was 10.05, 10.28. So this also traded in between the bid and offer. So there's negotiability there. That's what it's telling us. There's liquidity in the markets. There's negotiability to price improve beyond the displayed markets. And the VWAP price at that time was $395.35. So this gives us an idea of some of the top traded spreads. And if you're happen to be looking for a put spread, if that's what that fits your portfolio, fits your unique outlook, whether you're buying it or selling it, well, now we could see which ones are trading. We have two right there, one in the very near term, one going out further. We could see that it traded many times. This one 128 times, this one 245. We have now an idea where the prices are trading relative to the markets. So again, if you're looking for this type of spread and you're looking for something that's already traded, established, there's an established market price, there's potential for price improvement for sure. These could be candidates to look at. All right, so that's one approach. If you're looking maybe for call spreads, let's say you're interested the other way and you're looking maybe for call spreads, well, we could just sort them out and say, just show me call spreads. Click on that. And now we see the largest call spreads that are trading in Tesla. So the top one here happens to be the January 31st expiration. the 400, 420 call spread. So this, again, is 4 days DTE strike price. The difference between the lower and higher strike price, $20, traded for $8.48. With the market 830, 858, spot price reference 442. So this is, lower strikes at the money, higher strikes $20 out of the money. Average price 848, traded over 4,000 contracts and 30 times. And if you open this up, you could get more details from the time and sales. These are the different trades, and you could dig in deeper for each leg. So let me close that. And this is looking at the multi-leg trades that were trading yesterday. We're not open today, so these are all yesterday's trades. What about the single leg trades? So this is looking at types of spreads. What if we were interested in just what's going on in single leg trades? So let's come back here to Tesla and look at the single leg dashboard. This will give us a summary of what's going on in single leg trades. So keep in mind, all this is filtered out for trades that are not part of a multi-leg trade or contingent trade. And here, since we're just looking at what options are trading, we have the top 5 most active options. And if we look at the top 5 most active by volume single leg trades, we see that they're all January 31st expiration. So that expiration is pretty active, and probably because that's the one that covers earnings and it's short term, and the traders are looking to price that earnings to either hedge or to use options based on their particular outlook, mitigate their risk. So that's what the options traders right now are looking. Top 5 all cover January 31st expiration. We have a mix of calls and puts. So you could see here, put, call, put, call, put. No particular, bias for calls or puts from that perspective. And we do see that it's 3 of them are near that the monies. You got 400 put, 400 call, 395 put. 2 of them are out of the money by $50. We got the 50 put, 350 put, and then the 450 call. So the strikes do have like a range of like $50 around at the monies. And we get a sense of where these premiums have been trading. So these are the VWAP prices. So you can see here, $18.06 for those at the monies. Out of the monies are trading 261 in the puts, 385 in the calls. This one, it's close to at the money, 395 put, $16.44. It's a quick way to get a sense of what's trading, and if something pops out at you, like, oh, maybe I am interested in this put that's $5 out of the money. If you click on that, it'll take you to the options chain, and then we can perform more analysis on that particular put, get time and sales and so forth. So this is like a summary page. Let's see. These are the most active. So this is accumulation of the trades throughout the day. What about particularly large trades that that happen, that look like it was a big trade during the day? So we're going to slide down here, and these are those notable trades. So here we see there was a January 31st 430 call traded over 1,000 contracts for $7.50. Our interpretation is that it was an option with an incoming order to buy. Bought. You can see that it traded again, so we got twice. It's traded. We have February 28th. So this is going out a little bit further. The 600 call. So this is already, way above the at the monies at this point. 1,000 of those traded for an average price of $1.46. We also interpret that as an incoming buy order. Another large trade was the Feb 14 280 put. So this one's now way out of the money because we're near 400. That traded at 80 cents. We interpret that as a incoming sell order. And then a January 305 put. This is way out of the money, right? We've got 95, 90 points out of the money for 51 cents. That will expire also at the end of the week. For 51 cents, we interpret it as a bought. And these are giving us just ideas of most actives, large trades, and it's a quick way to see if anything there pops out at you that you may be interested in that, again, fits your either unique outlook or your portfolio for risk management. So let's say we're looking at these January 430 calls, and there's two ways we could look at it. Maybe it's a call that,
We did get a question from Michael. He's asking, how do you know if they're, obviously in any transaction, there's a buyer and seller, but I guess it would be the pressure on it. How do you mark it as, how do you know if it's a buy or a sell? Like if it was buy?
Yeah, that's a good question. And when we look at the markets, so obviously every order has a buyer and a seller. A transaction has to have both. You have a buyer and a seller, and that's in any transaction. It's a real estate, whatever you're looking at. You need a buyer and seller to have a trade. All right, piece of art, whatever it is. So the idea here is, well, where's the incoming order, the pressure that initiated it, right? So is the incoming order, so you have liquidity providers and you have liquidity takers. So where is the incoming order or end user or the taker coming from? Okay, that's what we're trying to figure out because, the more buying pressure you have, the more pressure you would have on the relative price, right? If the more sell pressure you have, the more pressure you have on the relative price the other way. So when we look at it, there's no indicator on the trade tape to let us know that the incoming order was a buyer or a seller. They just give us the trade. So we have to look at the surrounding data and information to make that interpretation. So this is an interpretation, okay? And when we look at that interpretation, we would have to look at some of the surrounding markets, the surrounding data, and come up with what's the most likely scenario. One way is to just look at the trade. Let's say the market right now is $6.20, $6.30. We could look at that, and if the trade, let's say, happens at $6.30, we could interpret it that there was an incoming buy order, right? Because the trade happened on the higher end of the displayed bid and offer. Okay, so somebody was willing to pay the higher end of the bid and offer, and the market there was displayed, so it was providing liquidity. So somebody stepped up. That is one way to look at it, but with markets, they're not only made up of, you know, specialists and market makers. The displayed market is made up of the limit order book and other traders or end users or retail customers that are putting in orders that will make up that bid and offer. Okay, so you could have a wide market and somebody could put something, a limit order. It could be a resting limit order, or could that was there for a while and the market moved towards it. It could be a limit order that tries to get an improved price. It puts it somewhere in between the market and it gets posted because the market, nobody was willing to take, trade it at that moment. But if the market moves, they could take it. Even a market maker. So those are different scenarios that we would have to look at and try to ascertain. So our system runs it through an analysis. There's no like one quick rule. It runs through the analysis, analyzing the surrounding data to make that determination. Okay. So for example, here I'm looking at the market 875, 880. And even before I see the trade, something there is looking like there's a pressure from the sell side. Okay, somebody is trying to move that market down to negotiate and entice a buyer to come in. Okay, so there's a pressure on the sell side, and I could tell just by looking at it. If you look at markets all day, right? If you know markets, it will stick out to you almost immediately that something right here on the 420 is happening. Okay, and how do I tell that? Well, just looking at the strikes surrounding it, right? Here's the 417.5 strike. Here's the 422.5 strike. And I could see that here, the bid and offer is 10 cents, 805, 815. Here it's 15 cents, 945, 960. So this one's very tight, 5 cents. Which is indicating, well, why is that one so narrow? If it was just market makers, liquidity providers, then their objective, right, is to make the spread. So why did that one tighten up? Maybe something's going on there. Somebody wants to do something. Somebody's trying to negotiate. Somebody's putting pressure on one side. It could be a resting order. It could be an implied volatility pump. But something there is going on. You could even go strikes above it. Here's 10 cents there. You could see this one's unusually tight. So there's interest there, right? There's interest there on one particular side, but how do we know which side? Which side is putting the pressure on there? Well, we could use the Black-Scholes model to create a relative value. And that's why you're seeing this little implied volatility lit up white instead of green. It's an indicator. So you could see here how the implied vols are lined up. Look on the bid, 86.5, 86.8, 87.1. So you could see that they're climbing, right? As you're going up in strikes, implied volatility is climbing up here. But we don't see the same thing on the ask side, right? You would look at it, it would be smooth. It would be similar. The bids and offers would be smooth. They're not usually jagged, because if you're a market maker, a liquidity provider, you have a smoothed out curve. It's not jagged unless you have a pump in there for something specific you're trying to do. All right. So here we see it moves from 87.2 down 86.9, and then back up 87.4. So there we see that it tightened up, which appears to be on the ask. Right. So now we got more information going on here, that there's an indication there in the marketplace prior even to seeing any trade, that there is a implied volatility pump on the offer. So there's a seller there. They're trying to entice a buyer to come in and trade at a better price. Right. So they're willing to sell, they're showing their hand, they're willing to move their offer down, and they're trying to get a better price to entice a buyer, which could be a market maker, specialist, whatever it is, to trade with them. So even in this scenario, if we see that something is happening traded at $8.80, we could see that the one stepping down, the one that's really trying to initiate and enticing those buyers, is on the ask side. There's a sell pressure there. Somebody's actively displaying that. So that's just one scenario I'm showing you, because we could view it, see it while it's in a still picture. And these are the types of analytics it's running in the background to determine if the initiating order looks like it's aggressive on the buy from the sell side or buy side. Okay. But Will, you know what? That took a while because we're right up at 9:30, so I'm going to stop right there.
Yeah, that was awesome, dude. I love that analysis and look at the trades. That was very cool. Very important going into earnings. We do have a big earnings season, a lot going on in the market as always. Everyone have a great trading day. Remember to like us, follow us on YouTube, all the services. Great job, D. Thank you very much.
Yep. Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you